If you have more than $250,000 sitting at a single bank, part of that money might not actually be insured. Not at risk in some dramatic sky is falling way, just genuinely, technically not covered, the way the rule is written. And the reason this catches so many retirees isn't carelessness. It's that this rule was built for a much simpler financial life than the one most people have by the time they retire. I want to walk you through exactly how this works, where it quietly catches people, and the fix, which takes about 10 minutes and doesn't cost anything. Here's the part almost everyone gets slightly wrong. FDIC insurance is not $250,000 per account. It's $250,000 per depositor, per insured bank, per ownership category. Three things have to line up for you to know your real coverage: who owns the money, which bank holds it, and what kind of ownership category the account falls under. Miss any one of those, and your mental math is off. So picture someone with a checking account, a savings account, and 2 CDs, all at the same bank, all held individually in their name. If those 4 accounts add up to $400,000, the bank doesn't see 4 separate $250,000 limits. It sees one person, one ownership category, one $250,000 ceiling. The other $150,000 is sitting outside FDIC protection. That's the single most common misunderstanding people have about their own banking safety net. Not because it's complicated, but because nobody explains it until it matters. This isn't really a retiree rule. It's a rule that applies to everyone, but it disproportionately catches people later in life. And here's why. It's the natural result of doing things that are otherwise smart. Think about the financial events that cluster around retirement age. Selling a family home and holding the proceeds in cash for a few months while deciding what to do with them. Consolidating accounts after a spouse passes away because managing 5 scattered accounts alone feels like too much. Building a CD ladder for stability instead of taking on stock market risk. Rolling over a pension payout or an old 401k into a bank account temporarily during a transition. Every one of those is a reasonable, even prudent decision. None of them are mistakes. But every one of them also tends to concentrate money into fewer accounts at fewer banks, which is exactly the condition under which people accidentally cross the $250,000 line without realizing it. Nobody sends a notice when this happens. There's no form that pops up. Your balance just sits there, uninsured past the threshold, and everything looks completely normal until the day it isn't. Most people go their entire lives without their bank failing. But it does happen. We saw it happen in the US in 2023, with more than one mid-sized bank collapsing within days. When a bank fails, the FDIC steps in almost immediately, and insured deposits are typically made available very quickly, often the next business day. That part of the system works well, and it's worth knowing that. But the uninsured portion of your money doesn't just disappear, and it also isn't guaranteed. It becomes a claim against whatever the failed bank has left in assets. Sometimes regulators arrange for another bank to absorb everything, insured and uninsured deposits alike, and people are made whole. Other times, uninsured depositors get back a partial amount, and it can take months or years working through the receivership process to see any of it. The point isn't to scare you into thinking bank failures are common. They're not. The point is that probably fine and insured are two very different things, and it's worth knowing which one actually applies to your money. Here's the part that takes 10 minutes. Step 1. List every account you have at each bank, checking, savings, money market, CDs, and add up the totals per bank, not per account. Step 2. If any single bank's total is under $250,000, you're covered, and you can stop there for that bank. Step 3. If any bank is over $250,000, you have real options, and none of them require moving your whole financial life around. Opening an account at a second bank and shifting the excess there is the simplest fix. It immediately creates a second $250,000 bucket. You can also restructure how the money is titled at the same bank, because ownership categories each get their own separate coverage. A joint account with a spouse is a different category from an individual account. It gets its own $250,000 per co-owner. So a joint account can actually be covered up to $500,000. A properly structured payable-on-death account, sometimes called a POD or in trust for account, can add additional coverage depending on how many beneficiaries are named. Certain retirement accounts, like IRAs held at a bank, are also insured separately from your regular deposits. Step 4. Just ask. Every bank is required to be able to tell you, in plain terms, how much of your specific balance is insured, given exactly how your accounts are titled. You can also check this yourself for free, using the FDIC's own online tool called EDIE, the Electronic Deposit Insurance Estimator. You put in your account types and balances, and it tells you exactly where you stand. No sales call, no advisor, no fee. If your money is at a credit union instead of a bank, the same idea applies through a different agency. Credit unions are covered by the NCUA, the National Credit Union Administration, instead of the FDIC, but the structure is nearly identical. $250,000 per depositor, per credit union, per ownership category. The name on the agency changes, the math doesn't. While you're checking your accounts, this is also the moment to check something else that trips people up just as often: whether your accounts actually have a payable-on-death beneficiary listed. A surprising number of people assume their bank accounts will simply go to the family, the way a will directs. In practice, if there's no beneficiary designation on file, that account can end up tied up in probate, the court process that settles an estate, even when a will clearly says who should get it. A POD designation bypasses that entirely. Whoever's named gets direct access to the account, usually within days, just by showing a death certificate and ID. It costs nothing to add, and most banks let you do it by filling out a single form, sometimes even through your online banking portal. It's not the topic of this video, but it's exactly the kind of thing that's easy to fix in the same 10 minutes you're already spending checking your coverage. So, here's exactly what to do this week, and none of it costs anything. First, add up your balances by bank, not by account. Second, if any bank is over $250,000, either open a second account elsewhere or ask about restructuring ownership categories at your current bank. Third, use the FDIC's EDIE tool, or just call your bank directly and ask them to confirm your actual insured amount in writing. Fourth, while you're at it, confirm whether your accounts have a payable-on-death beneficiary listed, and add one if they don't. This is general information about how deposit insurance works, not personal financial or legal advice. Ownership categories and trust account rules have specific requirements, and if your situation involves a trust, a business account, or a more complex estate plan, it's worth a conversation with your bank or an estate attorney to make sure everything's titled the way you think it is. None of this is about distrust in banks, and it's not a sign anything is wrong with your money right now. It's just a structural detail in how deposit insurance was written decades ago, for a simpler kind of saver, that never quite caught up with how people actually manage money later in life. 10 minutes checking your numbers is the entire fix. If this was useful, it's worth sending to a parent, or anyone retired who's consolidated accounts in the last few years. It's a small thing to check, and it can matter a great deal.